Very good. Well, good morning, and thanks for having me on. It's been another good quarter for the company. We're, as you said, we're strengthening the balance sheet, the seventh quarter in a row now where net debt has come down. We're growing returns. You mentioned 13.3% return on average capital employed. We're growing distributions, another 1.5 billion of buybacks announced in the quarter. And at the same time, as you point out, we are leaning in and accelerating the transition. So we call it performing while transforming. I know I sound like a broken record, but that's what we're doing. We're performing and delivering for our shareholders today, while at the same time leaning into the future and transforming the company for the future.
There's no doubt about it. The high oil price is helping that transition for you at the moment. But we know the kind of pressures you're under. I'm going to make it far more simplistic than it is. But you're under pressure from governments to supply steady energy, from consumers to supply cheap product rather than responding to every move from OPEC. Plus, you've got shareholders who just want returns. Let's be honest about it. There are some who aren't on board with your ESGIs and your transition ideas as well. And there are those who are stakeholders who just want to see a swifter transition. I don't feel sorry for you, Bernard, because you're very well paid for what you do, but it is a delicate equation at the moment for you. How are you negotiating that?
I think the greatest pressure is from ourselves to perform and create value for our shareholders and accelerate our transition plans. And yes, of course, the high oil prices help us. But if you look at what we're doing inside the company in the last 2 years, we've taken out $2.5 billion of costs, 6 months ahead of schedule. We're on track for $3 to $4 billion of costs to come out. We've just completed the largest restructuring in our history. We've had a record gross margin in our convenience business, up 20% on 2019. Basket sizes within our stores up 20%. And we're leaning into the transition. In the fourth quarter alone, each and every week, we added 115 charge points to our network, having almost doubled it in the last 12 months. What I am really excited about, Steve, is the opportunities that the transition presents, the opportunities for our company to get to net zero, and that's why we've announced accelerated plans around our emissions today, but also the opportunities to create value. If I look at bioenergy, if I look at EV charging, let's take bioenergy. Why wouldn't we use our refineries to create biofuels that are hugely in demand, to create sustainable aviation fuels that are going to be a key part to driving aviation emissions down? We can use our refineries. We're investing in biogas. And we think that we can create around $9 to $10 billion of EBITDA by 2030 from what we call these transition growth businesses. And that means that over 40% of our capital by the middle of this decade is going to be going into the transition. So hugely excited, actually, about the performance of the company today, as well as the investment in and the opportunities presented by the transition.